Hi, everybody. Welcome to September. Markets were closed yesterday. I hope everyone had a wonderful Labor Day, enjoying your labor and some rest time with friends and family. And so we'll kind of dive right in. We kind of reflect on previous month of August, but we'll also kind of talk about some market outlook. And I know you're probably saying, Nora and Sean, you talk about this every month. Conversations we're having with clients is, it's been a long 8 or 9 months, right? Since year to date. And so when we look at August, we did see some positive things come out and the market reflect that, right? The inflation number came out in August for July. That went down from 9.1 to 8.5. So markets reacted to that. We saw some good things come out. When we look at last week, when we're wrapping up August, getting into September, Sean, talk to us about kind of what happened. It's been a wild roller coaster. Why was the market? What were investors reacting to? What were their thoughts last week?
Yeah, so essentially, we had Chairman Powell, Federal Reserve Chair, met with a lot of the top academics, a lot of World Bank leaders in Jackson Hole, Wyoming. They can do this every year. And obviously, they have a lot to talk about in a year like this. And following that meeting on Friday, they gave a little speech. Really, the market had been doing pretty well since June 14th. We saw a low on June 14th this year. We saw the U.S. stock market down about 25% year to date. Our previous high was 31 December. So it had been a really long time period since we saw a good market. And starting from June 14th, really up until last week, things started to come back, right? We started getting about 10% of the market share that came back. And then Chairman Powell spoke on Friday and essentially said he's going to continue to be extremely hawkish, meaning he's going to continue to raise interest rates. And so what happened was in June, we had kind of real inflation being around 9.1%. And in July, it got reduced down to 8.5%. And so the market started saying, hey, I'm starting to see some changes in the overall economy. Inflation's coming down. Let's go ahead and let's have this market kind of come back. And then last Friday, Chairman Powell was like, not so fast. I'm going to continue to raise interest rates. So the market since that time point has acted pretty negatively. Really have not had a good day in markets since Chairman Powell came out and kind of brought up that he's going to continue to raise interest rates. What's interesting is he brought up kind of a famous Fed chairman, Paul Volcker, that was around in the late 70s or early 80s. And that was kind of the last time period we were in that's similar to this. And so what we saw at that time was a lot of government spending, just getting done with Vietnam. We had President Nixon kind of trying to expand Social Security. So lots and lots of spending. We also had President Nixon trying to kind of keep inflation down by influencing the Fed. So they're trying to keep interest rates down, influencing the Fed while doing lots of government spending. We had a lot of inflation there in the 70s, including kind of getting off the gold standard or some other factors that kind of played in there, but really high inflation, similar to what we're going through now. And it wasn't until Paul Volcker came in as the Fed chairman that he really started raising interest rates very aggressively that we got inflation under control. So we had inflation, in the double-digit range. He was able to get it down about to 3.4% by the time he's out of office by continuing to raise interest rates. So Chairman Powell said, I'm going to kind of channel my inner Paul Volcker and continue to raise interest rates. And that's what's really been driving the market down is, okay, we're not on our way down from this inflationary peak. We're going to continue to see rising interest rates. Now, all that being said, when we look outside the window, we're also seeing lots of deflationary things happening. Right, homes are sitting on the market a little bit longer. Right, earlier this year and last year, they're on the market for 3 or 4 hours. Now they're on the market for 3 or 4 weeks. We see prices actually being reduced on Zillow, right, which I still follow, but prices coming down. And so we're starting to see those things happen. I filled up my tank this morning for $3.51. I had filled it up for over $5 a gallon before. So prices are coming down when we look outside the window. We had the good inflationary number last year by it being reduced from 9.1 to 8.5. What we're hoping for is on September 13th of this month, we're going to get the next inflation number, right? What we find out from August. I've already started to have some bad home numbers come out. We're thinking that number is going to come down, and hopefully that kind of gives the market some pause and a lot of this kind of contraction that we're going through. And then in September 21st, we're going to find out about the next Federal Reserve interest rate. So at Jackson Hole, they didn't actually announce any interest rate hikes. It was just fodder for fear, right, for the markets and for people. There was no actually decision being made there. But I think the markets since that time period have been trying to price in a new interest rate hike. We've been doing 0.75% interest rate hikes in the past. The market might have thought, hey, we'll get some good news at the end of September. Maybe it'll be 0.5%. And then after the Chairman Powell's speech last week, they're saying, okay, it's probably another 0.75% then. So we're kind of pricing that in there all the way until probably September 21st time period. Hopefully some good news on September 13th. We'll learn some more on September 21st. And we'll kind of go from there in terms of how we see things happening. Things that we're doing inside of our portfolio, we're holding on to cash, a little bit more cash than we normally do. Normally we're trying to spend it pretty quickly when we get it in, get it invested in the market. But we want to kind of see how a lot of this turmoil plays out before we go spend cash and buy some of those equities while they're discounted.
Thanks, Sean. And one thing to kind of keep in mind, again, inflation's a lagging indicator. So it'll be reflective of this past month, which Sean kind of mentioned. Some things as we look out the window have been pretty positive in terms of prices going down. And then when we look at historically, when the interest rates rise, the market has, reacted pretty positively once known information is out there, right? Because it's kind of been pricing that in. So a couple of things to keep in mind as we look into some of those numbers coming out in September. One of the things that I'm going to kind of put you on the spot, Sean, with some questions and conversations that we've had this past month. One, a lot of talk around recession and some kind of confusion on what determines a recession. Are we in a recession? Are we working our way out of a recession? Can you kind of explain that for us?
Yeah, so ultimately a recession means the economy is contracting, right? At the same time it's contracting, maybe we're also starting to get some higher unemployment. So we've got kind of the White House coming out and say, what recession? We're not in a recession. And a lot of that is, there's some foundation to that, right? We have unemployment at 3.6%. Back in 2020, during the coronavirus recession, we had unemployment as high as 15%, right? So it's a big change from just 2 years ago. We got people out there looking to hire people and they can't because everybody's employed and they're able to kind of quit their jobs because they say, hey, I want to work from home, or this job's too stressful, and there's lots of other jobs that are available. So it's hard to say, hey, we're in this contracting economy, things are tough, we're in a recession when unemployment's so low. So, that's kind of where the White House is getting their rhetoric from. I think they're probably putting the cart before the horse, and here's why, right? So the way that I kind of see a recession, because it affects me in this regard, is when the markets are down 20%, right? When the markets go down 20%, being usually the S&P 500, people start to change what they're doing with their spending habits. And those changes are going to be impacting the market, right? That contracting economy, as people start to spend less money. People see their 401ks down, people see their investments down, they start to save a little bit more. They start to take action that's going to say, all right, I'm not going to be spending as much money because I'm saving more, because I'm a little scared, right? So that's one way to kind of define a recession, would be a 20% drop in the market. Kind of the most commonly way to define a recession, based on most economists, is 2 quarters of shrinking GDP. Now, GDP is the gross domestic product. It takes into account how much we're importing, how much we're exporting, how much the government is spending, how much consumers are spending, to come up with kind of a number. The hard part about defining recession with GDP being down is no one really knows what GDP is, right? It's this macroeconomic term that any normal person is going to be like, I don't know what that means. They're going to talk about it at the bar or at the golf course, but they don't know what it means, right? It's really, really hard for us to conceptualize what GDP means. So we are in an economy that has 2 shrinking quarters of GDP. So when you say, hey, we are in a recession, we've got a market that was down over 20% through June 14th and is testing those waters again here today, which would be a measure of a recession. We have the GDP down 2 quarters, also another measure of inflation, of a recession. However, we have low unemployment. So another measure of kind of a recession that the White House is using is called the SOM effect, which essentially says when we got the 3-month moving average increasing by 0.5% compared to the previous 12-month low. That's a really, really nerdy talk, right? But it essentially says, is unemployment rising by more than 0.5% compared to the 12-month low? And so right now we're at 3.6%. A way to kind of define a recession would be, do we see unemployment north of 4.1%, say? That may be another way to kind of measure a recession. So what's happening, right, and what we're seeing when we're talking with clients right now is we're starting to see some of that contracting economy. Okay, we're starting to see people make decisions to not spend money. We talked to a client that does a lot of boxing, right? Sells boxes. Some of those orders are down, right? Again, people are going to stop consumer spending, stop shipping things in their boxes, a sign of kind of shrinking economy. We talked to retailers. They've kind of been ordering inventory. Now they've got too much inventory. Again, kind of pre-COVID and during COVID, they couldn't keep toilet paper on the shelves. They couldn't keep Clorox on the shelves. Now they have too much of it on the shelves. They're trying to reduce prices. Again, another measure of deflating to kind of see if they can get that inventory off their books. We have people talking about their supply chain, their business is kind of pre-COVID demand, right? It's able to keep up with that. Not necessarily to keep up with post-COVID demand just yet, but the supply is also building back up. The same is true with the housing market, right? Houses are sitting on the market for a little bit longer. That supply is building back up as the interest rates have been risen. So we're starting to see things start to change. What the Fed will probably continue to do, right, is raise interest rates until they start to see that unemployment number go up, right? Based on what the White House is saying, based on, right, a lot of different ways to measure recession. They don't really care if the GDP is down, if people can keep spending money. Because up until this point, when we talked to small business owners, 2021 was their best year ever. 2022 years outpacing 2021. They're booked out through the end of the year. We see large corporate earnings reports come out. They're exceeding analyst expectations. We have jobs numbers exceeding analyst expectations. All those things lead to a strong economy, which is why the White House is saying, hey, we're not in a recession. We've got low unemployment. People keep spending money. But my 401k is down 20%. Why is that a problem, right? So that's a lot of what's happening right now and kind of three different ways to define a recession. I think ultimately, if you look at it as we have a shrinking economy, a contracting economy, and unemployment is rising, that's going to be a good way to define a recession. Kind of got two of those three benchmarks already defined. I have a feeling we're going to start to see people be unemployed or start getting laid off as interest rates rise. Businesses aren't going to be as excited to borrow money and therefore maybe not able to keep up with some of those expenses if things slow down. Therefore, they'll start to lay off people. So we may start to see a tighter labor market over the coming months when it comes to defining a recession.
Thanks, Sean. And another topic that we've kind of talked about that came out in August, really President Biden came out a couple weeks ago talking about the student loan forgiveness and repayment extension. Really, if you look at it, the press secretary is really deflecting a lot of comments on that. So can you just provide some clarification on what does this mean? If this is part of your financial plan and you have student debt, does this mean, is 10,000 automatically going to be forgiven? What's that process look like? Do we even know?
Yeah, so I think it's being deflected for good reason. I'm not sure how it's legal. One, presidents historically cannot just go out and spend $300-500 billion with a strike of a pen. So I'm sure there will be some contesting things that apply to that. What we've been telling clients really up to this point is pay off your student loans so you get to about $10,000 left, and then we'll see what happens. And so that's kind of what was our advice over the last really 2 years, really since COVID came out and they started delaying these things. And now they kind of get that news that it will kind of be forgiven. A lot of different rules are going into that. And that, like I said, there will be some complications to it. I think the White House is probably deferring and not talking about it because they don't really know how they're going to pay for it. There is no line item in the budget to forgive it. It hasn't been congressionally approved. But once you tell people that, they've probably already started to change their spending habits, right? And so that's one of the things that we are cautioning people is we had all these really good signs of a deflating economy in terms of oil and gas, in terms of supply kind of picking back up. And then we go get, hey, we're going to go spend $500 billion more dollars in the economy, therefore increasing inflation again, because now people, rather than spending $300 to $500 for student loans, maybe they take another vacation, maybe they buy another car, maybe they update their cell phone, whatever. And again, that's going to lead to more spending, more consumer spending, more inflation. So all that remains to be seen. I think right now it is, let's wait and see what happens with it. It was a good press bite to get some votes here before November. We'll see if it actually plays out or how it impacts the economy overall. But generally speaking, it was a inflationary decision in a time that we're trying to get deflationary things to happen. And those deflationary things were happening. So overall, we'll kind of see how it plays out at this point. Our advice to our clients continues to remain the same. hold off. Don't go changing your spending habits, right? If you've got $10,000 in student loan, don't go out and spend $10,000 on that new boat. Let's wait and find out how this plays out, and let's see when the rules get clarified about how you're going to actually get this process and this thing, kind of forgiven, if you will. So that's kind of our message to clients right now.
All right, thanks, Sean. And then one last kind of topic or question is really around passive income. Last month, we talked about I-bonds, which really not necessarily passive income, but more of a conservative diversifier in your portfolio. Some questions have come up, and I know a lot of people have probably thought about that, is real estate, right, in terms of passive income. And a lot of companies have started coming up more of like kind of crowdfunding type platforms in terms of real estate. So what's kind of some information if investors are looking for a way of passive income, specifically in the real estate kind of industry or market, what would you say to them?
Yeah, so I think, people and companies will go wherever the dollars are flowing, right? And when people are talking about these things, companies will start. And that's kind of what we're seeing is there's lots of different ways now to become this passive investor. One thing that we're cautioning people about, right, is in all real estate, there's always lots of transaction costs. When you're adding another member to that, you're also going to increase your transaction costs. By that, I mean, if I buy a house for $100,000 and sell it for $200,000, I didn't make $100,000 on that, right? I had to pay realtors. I had to put mulch on the yard every year. I had to update the kitchen. I had to pay stamp fees and transfer fees. Maybe I had to pay a property manager if I was renting it out. And now I got to pay another third party to start it. If I start an LLC, I had to create an LLC. All these costs go into it. And I didn't actually make that $100,000 that I tell people I made, right? If I'm being honest with myself, there's lots of transaction costs. So when you get into these real estate things, understand that those costs don't go away, right? You can't just, go by scale and say, hey, we're just going to eliminate all of those costs. Those things will still exist. And so when you're evaluating an investment, try to understand what you're really owning. Also, right, one of the cautions with real estate is if I say, hey, I'm going to start Sean Carney Real Estate Fund, give me your money and I'll go buy real estate with it. How do you know that I actually bought real estate, right? And this kind of gets back to a lot of things that were happening with like Bernie Madoff, right? And a lot of these Ponzi schemes that still exist. I have clients that came in and said, hey, we were ripped off by a crypto scheme here in Columbus, Ohio, right? An oil and gas master limited partnership here in Columbus, Ohio. Like there are still people that are doing these things. So be very cautious about getting into some of those things. Because, when you invest with us, right, you're going to see that your money's at TD Ameritrade, a brand name institution, and you're invested in high quality funds from Vanguard, Spider, and iShares. And you're going to see that, hey, this is exactly where my money's at. And I can feel really comfortable and confident in that. If I'm investing in real estate, how do I know that that money's not sitting in, my bank account and I'm just paying out other investors with someone else's money? So those are all things to understand is really get a good solid grasp of how this business is working, how it's going to make money. Don't just get caught up in, oh, give me your money. And then all of a sudden I'll start to get passive income. We've seen scheme after scheme after scheme, privately held real estate investment trusts, master limited partnerships, all sorts of these things end up just getting eroded with fees, hedge funds, you name it, eroded with fees. The only person making money is the person selling you that investment. So don't necessarily fall for that. If you do get into it on your own, right, there are some great opportunities, but typically speaking, things to be careful of, it takes a lot of capital to get involved, right? You have to invest a lot of money. There's usually the people that make the most money at doing it, put in a lot of sweat equity, right? So you got to get really involved, and then all of a sudden it becomes a lot less passive. And so you start to build this portfolio of homes with putting forth a lot of effort, which again is fine. It can end up being a great diversifier for your portfolio. And I do think it's a great diversifier for a portfolio. So you'll get involved in some property. Just don't overextend yourself. Don't put too much of your portfolio in it, and be wary of some of those transaction costs and the sweat equity that may go into it in order for it to really pay off for you in the long run.
All right, thanks, Sean. That kind of wraps up some of the topics that we want to talk about. Those watching on Facebook, appreciate it if you made it this long. I know it's been a little bit longer than some of our other monthly market insights. But if you have questions, send them in to us. Have a wonderful September. We'll meet back the first Monday of October.
Thanks, everyone. See ya.